All right. Good day, everyone. Good to have you here. Welcome to the Tatro Show. Today is Monday, July 6th, 2020. Pretty excited about our guest today. Bringing him in all the way in from, I think, his home. I think he's working from home today, but he's out in Montreal. Are you in Montreal? Yeah, I think I'll bring him in. Give me a sec here. Folks, just want to set this up real quick. Sorry about the technical delay when we got started here. I'll bring Martin Roberge in right away. Bienvenue. Welcome, Martin.
Thanks, Rob, and thanks for having me on your show.
I can't quite hear you.
Hello?
I wonder if that's my sound. Martin?
Yeah.
There we go. All right. So welcome to the show, Martin. Pretty excited today, middle of July. Catching you maybe on holidays? No, you don't take holidays, do you?
No, well, I do, but in August only.
Okay. You are in Montreal, correct?
Well, South Shore. I'm in Candiac, which is about 20 minutes from Montreal.
Okay, good. There's some highlights today. There's some, before we get into it today, Martin, got some pretty neat material that we're going to cover today. A couple highlights. The Dow rallied hard today. Up about 400 points here just before close. Overseas markets were up big. Amazon, Netflix hit records. Anything surprise you today in the market?
No, it's we're continuing to see the same large cap or mega cap sectors driving the market higher. It's getting a little bit broader, including some cyclical stocks. But obviously, it was a good day from a breadth point of view. But most of the performance comes again from the U.S. mega cap stocks.
Okay. For those of you that don't know, I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. I've introduced him, but I'll bring him again more formally. I'd like to introduce right now Martin Roberge. He's Managing Director, North American Portfolio Strategist here at Canaccord Genuity. He's got a CFA. He's been doing this for a while. He's been right on a lot of calls in the past since I've gotten to know Martin. Incredibly smart guy and bilingual for those of you that it matters. Kind of neat to talk French to a guy once in a while. In addition to that, I want to remind you, if you're watching on Facebook, please take a second to follow our page, to like and share. If you're watching on YouTube, please click the red button to subscribe. Subscribe to our videos, subscribe to our channel. And also, if you're watching and you'd like to ask some questions today, feel free to put your questions on Facebook or on YouTube. We'd love to take some questions for you today, and we'll try to get to them if we have time. So not too much of a heavy day in terms of news, Martin? Like these July and August days, they get pretty slow in terms of macroeconomic news, right?
Yeah, once you pass the job numbers and the manufacturing PMIs, it tends to slow down. We have the regular stats coming out every single week, but it seems like the media is certainly slowing down, and in terms of reporting the good and the bad, while we're obviously going through the summer doldrums right now in terms of financial market coverage.
The volumes are also historically lighter in July and August. We're also keeping an eye on some job numbers that came out last week. We're going to be watching those this week. There's a front page article on BNN Bloomberg today that says that the headline is Bank of Canada says business sentiment is at its lowest since 2009. Any thoughts on that?
Well, it's like the survey was taken about a month ago, I believe, when we were just about to rebound and about to reopen the economies around the world. And obviously, if you look at the shorter term data, especially those from the United States, we've seen that the reopenings have the reopening of various sectors of the economy has led to a rebound in consumer sentiment. And business sentiment will take a little while because companies are not in the mood to spend. But obviously, consumer, with all the backstops, income backstop that they've received over the last couple of months, they are obviously more inclined to spend some of that money right now and stimulate the economy a bit.
And let's talk election real quick. I know you're not a political scientist. We had Tony Dwyer on our show last week. He said, I'm paraphrasing, I don't want to quote Tony, but I think it was something along the lines of Democrats or Republicans, there's so much spending that he doesn't really think it's going to impact the market one way or another, and he thinks it's mostly priced in. He refused to kind of comment on what he thought would happen. Do you have any sentiment, one, on what might happen in the election, and two, what might happen if there's a surprise?
No, I have a low degree of conviction. Historically, though, like those are the stats. When there's a sweep and the incumbent is being defeated, the market normally does relatively okay, relatively well. So, but we're talking about returns that are pretty much in line with like the 10% annual return. So it's just that it seems like the downside risk of markets lower when Democrats are running the country relative to Republicans. So in terms of upside potential, probably the same, but in terms of downside risk, Democrats do a better job.
Okay. Also, the news today, last headline here that we'll cover before getting into some pretty neat, some presentation slides that you prepared for us. Warren Buffett finally put some money to work, put $10 billion in an energy play in the U.S., sitting on I forget how many hundreds of million, 150 billion or something like that. He put 10 billion to work. What are your thoughts on that deal? And has he played this too conservatively?
No, like he's trying to it's kind of a broker type of deal where he clips obviously a commission on transporting that nat gas around the United States. So it's he's going to be controlling about 20% of all nat gas transportation around the country. And Warren Buffett tries to buy low and obviously sell higher. And as you know, nat gas has been trading below $2, like hit almost an all-time low a couple of months ago. And I think he's just smart about reinvesting some of that cash, that hoard of cash he holds in his funds, and redeploy by buying low, because a lot of stuff has done extremely well from the March 23rd low, and he's obviously looking at some of the laggards, and nat gas assets have been obviously lagging other risky assets lately.
Nat gas today up 10 cents, $1.83. TSX was up about 70 or so, trading right around 15,660. NASDAQ hit an all-time high today. Let's get into some of the headlines here. I will be sharing my screen. Martin Roberge is prepared some stuff for us. He is our North American portfolio strategist, quantitative analyst. Let me see if I can figure this out here. I know I can figure this out here. 1 second, folks. Martin, I'm going to bring up your presentation. So this is a document that you prepare, obviously, for your technical analysts and for your institutional clients and for the advisors as well, guys like me, and for my clients and for my viewers. So thank you. I understand you're presenting this tomorrow morning to your institutional call. So thank you for getting us this information, this content ahead of time. I'm going to skip a couple slides here to slide 2. I went one too far, I think. No, this is the one, right?
That's the one I will start with. Okay, today on the show, the case I'm trying to make is to rotate outside U.S. equities, or diversify away from U.S. equities, which have been outperforming global or international equities for about 11 years now. But it seems like we've got the conditions for non-U.S. equities outperformance finally. And one of those conditions is global growth reacceleration. As you know, the economy was hit very hard by COVID-19 recession, and now we're seeing at least the direction of the economy going in the right way. And this chart looks at the momentum, which is the black line of the economy, relative to the lagged impact of oil prices, bond yields, and the U.S. dollar. As you know, bond yields have basically collapsed this year, and oil as well. And we hit almost like we turned negative at one point in April, and the U.S. dollar has now started to depreciate. And those are like bottles of oxygen for the economy, so they act with a lag. And this indicator or these variables are represented by the blue dotted line on the chart, and you can see that going into the second half of the year, early next year, the blue line is going to be pulling higher the black line, which is the global economic momentum. So while it's very difficult to have conviction, Rob, on the level of growth, we've got better conviction on the direction of growth, which should be positive until spring next year. And I think we got another chart we can show, like the relationship between the economy and other variables. Yeah, that's the one. So this one is using the balance sheet of various central banks in the first panel. As you know, we've seen an expansion of balance sheets. The Fed, the Bank of Japan, the ECB in Europe have been growing their balance sheets by buying bonds, providing, again, liquidity to financial markets. And you can see the black line, which is, again, a measure of growth momentum globally. And you can see that hockey stick on the right, the balance sheet expansion by various central banks is signaling a strong recovery in the second half of the year. And same conclusion below when you look at the rate cuts that we've seen elsewhere in the world. Global interest rates were around 2-3% earlier this year. Now they are down to 1%. So we inverted the short-term lending rates, and you can see that this line of policy rates around the world, the drop is signaling also a quick recovery in the second half of the year. And I want to repeat, this is the primary condition for non-US equities outperformance, global growth reacceleration. US equities have a low beta. They need lower growth to outperform. They are less cyclical, but international equities are more cyclical. They are a higher beta group of economies, and they need more growth to produce more earnings. So they do well when growth accelerates, and they do poorly when growth decelerates.
So a whole bunch to unpack there. Earlier, you talked about bond yields. Bond yields have been kind of devastatingly low. If you're kind of buying bonds now, you're getting a lot less than you were a year ago or 6 months ago. Has been good for the value of the bonds because of the reverse correlation. You talked here about about QE and this printing of money, this added liquidity. This has been the theme of my show. It feels like everyone who's come on here in the last month or so. We had Tony Dwyer who came on. We had Javed who came on. I believe we had one other macro guy who came on, and this added liquidity into the markets, this QE, this expansion of balance sheets has been the running theme, and everyone's kind of calling now for a secular kind of bull market, depending on what happens over the summer here. And I'll get to that for you in a bit, Martin. But the balance sheet, the expansion of the balance sheet is kind of the theme of this slide as well.
Yeah, you're right.
So I'm going to skip ahead here. As a reminder, I'm here with Martin Roberge, Managing Director, Portfolio Strategist, CFA at Canaccord Genuity Wealth Management. I'm Rob Tatro from Canaccord Genuity Wealth Management, Portfolio Manager here. Let's take a look here. Got a couple other slides I want to take you through. I'm going to take you to slide 7, Martin. Or should I stop on this one? No, I should probably go to 7, eh? Yeah, so this is the global growth reacceleration is US dollar bearish. This is the title of this slide. So maybe what's the first of all, what do we see here, and then what's the big picture?
Yeah, the black line is the U.S. dollar index. Okay, it represents about like well, as you know, the euro represents maybe 50% of the basket, but the Japanese yen, Canadian dollar, Swiss
Australia.
franc, Australia as well. This is a basket of currencies relative to the U.S. dollar, and the blue dotted line is again global growth momentum. But again, I inverted the right scale. So when the blue dotted line falls, it means that global growth is improving. And when it goes up, it means that global growth is decelerating. And you can see very well, like I'm not reinventing the wheel here, you can see very well that the two lines are closely correlated, which means that if we are right about global growth momentum reaccelerating and this blue dotted line falling, it will be pulling lower the U.S. dollar line, the black line above, and this is the number two condition normally required to get non-U.S. equities going. Again, first condition, global growth acceleration, and secondly, U.S. dollar depreciation. And the depreciation of the U.S. dollar, if you look at historically the ups and downs, the U.S. dollar is a defensive currency. It does well when growth is weak. It does poorly when growth is fast. And as this blue dotted line is showing, we're kind of doing a downshift in this blue dotted line. And as I highlight in the chart, when the line goes down, it means that global growth momentum is improving. So from a directional point of view, again, it seems like we are starting a phase of U.S. dollar depreciation, which was again a condition missing over the past couple of years to see U.S. Non-U.S. growth, non-U.S. equities outperformance. And I think there's another chart highlighting how fragile or how vulnerable is the U.S. dollar going forward when I show relative to the twin deficits in the U.S. I think it's the following slide, Rob.
Yeah, we'll get to it in a sec. I want to just, we're getting a ton of questions from our viewers and our clients about USD CAD. And, you know, some of the other people on the show have said CAD will have a rough patch, or the CAD, the Canadian dollar, the loonie will have a rough patch here against the US dollar over the next while. And, you know, expect to see depreciation of the Canadian dollar against the US dollar. Now, we're not comparing that here, just to be clear for our viewers. We're comparing a basket of global securities, but it's mostly the euro, the euro and some other, I guess, Middle East and Australian currencies. So does that change your view on the Canadian dollar? Just
not at all, Rob. Like if you remember on your show, maybe 2 months ago, we took the view that it was very high likely that the Canadian dollar would experiment a tactical bounce as the economy was probably going to stabilize, and also this U.S. dollar weakening. Again, people can look at the Canadian dollar from two angles. One being like the Canadian economy doing well, commodities doing well, hence the Canadian dollar doing well because of its own fundamentals. But you can also take the other side of the trade and say the U.S. dollar is too weak. So when it is weak against a basket of currencies, well, a tide is lifting all boats. It's going to be weak relative to the Canadian dollar as well. So that means that there is upside for the Canadian dollar, but the strength, like marginally, I believe we can go as high as maybe 70, 75, 77 cents, but it will not be because Canadian fundamentals are positive. It's because of U.S. fundamentals that will be going from bad to worse. So when this portion or this side of the trade pushing the Canadian dollar higher, normally the upside is limited. So I would see this rally in the Canadian dollar topping out around 75, 77 cents, and then probably I'm going to turn cautious again. But by the time we get to 70, like again 75, 77, maybe the U.S. dollar will be bottoming as well. So for now, my understanding is that we have yet to see more negative from U.S. dollar fundamentals, which will keep the Canadian dollar afloat. Maybe another 4 cents from here, but it's probably the maximum we can hope.
Very interesting. I'm going to take you to the next slide here. This is the one that we were talking about. The
one before.
the twin deficits.
Yeah, that's the one.
So tell us first of all, Martin, what are twin deficits?
It's the sum of the trade deficits, like the export imports we do with the U.S. does with other countries. Okay.
So trade deficit, and how much you export, how much you import. The net, if it's a deficit, that means you're importing.
That's the trade deficit, and then you have the budget deficit. The federal, as you know, the federal government, like in Canada, the Liberals are spending like crazy to get the economy going. Well, Trump is doing the same thing in the U.S. Like the Republicans are spending as if there was no tomorrow to make sure that there's a recovery, obviously ahead of the elections, preferably. But the price to pay, because we haven't solved the trade deficit with China, and this is one of our big trading partner. Well, I'm talking about the U.S. big trading partner. The fact that we're not solving this trade dispute, and the fact that we keep on generating higher and higher budget deficits, makes me believe that we're going to run like into a situation where the twin deficit, which is the sum of the budget and of the trade, the sum of the two gives you the twin deficits, will reach about 18 to 20% of GDP by the end of 2023. And as you can see in 2018, I think on the chart, you can see that we hit almost like 10%. And this is when the U.S. debt was downgraded from AAA to AA. So it makes no doubt that the U.S. debt has been downgraded by the S&P to AA in 2011. But I think that the other rating agencies like Fitch will also downgrade U.S. AAAs to AAs, and that will put pressure on the U.S. dollar as well. So this is what I want to see. I want to see the market discounting this ballooning twin deficit before turning negative again on the Canadian dollar, because I believe that by default things are going to get worse in the U.S. relative. Like in Canada, we know it's going to get bad. We're going to reach almost 300 billion this year. Okay, but as a percentage of the GDP, it's less than in the U.S. So in relative terms, it's worse in the U.S. So I expect to see eventually the market, dumping some of the U.S. bonds, maybe. Because they feel that there could be a currency risk exposure, and this is all going to play out probably over the next 18 months. So we're not going to have to wait that long, and once we start accelerating to the downside, I believe that it's going to be quick. It's going to be quick, and that will coincide with the final re-rating in the Canadian dollar.
You and I have talked about twin deficits in Canada in the past. I remember you had mentioned it. I think one of the first guys to mention it in one of our, either was an event or you mentioned it, and you had mentioned at the time that it's tough for the Canadian dollar to appreciate relative to the US with the strong level of twin deficits that we had in Canada. And basically you're taking the same theory, the same twin deficit theory, and you're applying it to the US, and you're saying it's going to be worse in the US than in Canada.
Yes, that's why there is some upside left. It's like a contest of the dirtiest T-shirt. I don't know how you guys say it, but it's like this is whoever is gonna get the worst the worst deficit first, or the biggest deficit first. And as much as I know that in Canada it's going to get bad, it's going bad in a gradual way. In the US, it's going bad at an accelerating pace. Okay, hence this leg down in the US dollar that will keep the Canadian dollar afloat. But for the same reason you said, historically, when Canada runs twin deficits, it cannot go much higher than its fair value. And the fair value, which is the Big Mac index, like the price of a Big Mac in the UK, should be equal to the price of a Big Mac in Winnipeg. Okay, so this Big Mac index, which is called the purchasing power parity, um, gives a fair value around 77 cents for the Canadian dollar. So that's why I have a target of 75 with upside risks to 77 cents.
I loved it. I remember distinctly first learning about this Big Mac test when I was taking my courses, my MBA course at the University of Manitoba with Professor John McCallum. And he was teaching us, you take a Canadian dollar, you convert it to US dollars, you cross the border, you go to the Big Mac in Fargo, and you know, how much is your Big Mac going to cost? And you're saying the relative value should be 77 cents. And in a twin deficit, you shouldn't see it creep up much higher than 77. I remember you saying 80-ish, 80, 82-ish was kind of the max.
This is if oil gets probably above 60 and gets outside Canada. In order to look at the Canadian dollar above 80 cents, it's probably 60 on WTI and oil going out of the country.
Right, which
and as you
we
know,
don't have now.
Rob, we've got some pipeline issues for another 2 years, I believe.
Yeah, it's going to take, which is why we, generally we've been somewhat bearish on the Canadian dollar here at this price or close to this price. So you heard it here from Martin Roberge. The U.S. budget has a dirtier shirt than the Canadian because their twin deficit is slightly worse than ours. I'm going to go here to slide 9, Martin.
Yeah.
So this is about the bonds and what we're cutting. Here, I'll let you describe this slide, but you're talking about the yields here going from 0.75, just the change on the yields.
Yeah, it's just that like the yields have been coming down, and a lot of folks are saying that we should not rule out the possibility that 10-year treasuries in the U.S. Drop below zero, like in Europe, for example.
This is a 30-year chart. Those of you that are wondering here, this starts in 1990 and goes all the way to currently. So it's a 30-year chart, trend that we see here.
And what we show, it's a little bit of a technical chart because it shows the deviation from the 4-year average. Historically, the bond yields will oscillate around the 4-year average or the 200-week moving average, up and down. But normally you don't deviate like more than 200 beeps or 2% below this 4-year average. And the 4-year average is at 2.2% right now. So if you subtract 2% from 2.2, you get to 0.2. And you can see historically, like 200 beeps or 2% is the maximum downside you will normally see the bond yields when you go into a recession. So we cannot rule out a trip to 0% or 0.25 beeps, but it's very unlikely that we will stay in a sustained way below 0%. Yields are more likely to rebound. And again, understanding that the 4-year average acts like as a magnet. Well, the magnet is 2.2. So 75, you've got maybe 75 beeps to the upside, but you've got 120, like almost 150 to the upside. So the return to risk ratio is not that great. And again, I pledge your viewers that if they want to hedge against rising interest rates, preferred shares, convertibles, are some alternatives that they can buy to replace the income portion of their asset 60/40 mix. They can, like, you can buy preferred shares with resets, and maybe that's a topic for another show. But that's one way for you to protect your portfolio from a rising interest rate environment.
That's a good idea. That could be a great show. Just understanding preferred shares. People are so confused with preferred shares. It's a tough concept to get. They get the volatility of equities, and yet the yields of good bonds or global bonds. And you're wondering, why have they dropped so much? Why are these pressed? And the issue with the perpetuals and the fixed rate resets and the resets and the variable resets. And it's maybe a show for another day. But I will say this, my viewers and anyone who's followed me on YouTube knows that I've been preaching alternatives as a replacement to fixed income for the income portion for a long time, because you can't get 0.5% in fixed income anymore. What do you do with that? You can't retire off that.
But Rob, please tell you, like, for anyone listening to the show, please don't go 70/30 on your asset mix because you cannot find alternatives for the 40%. Don't do that. You will increase your expected return, but you will increase also your risks.
Yeah, I'm a big believer, Martin, and you know me. We cannot increase the risk for clients, because as much as they think they might be ready for it, your risk tolerance is your risk tolerance. You're born with it, and if you can't sleep at night if your portfolio is down 10%, then you shouldn't be 70/30. Because what we saw in February is you were down more than 10% over a 1 month period. So risk tolerance is something that we don't mess with. Volatility, and so for us, the key is to limit the equity exposure. If we're able to keep some alternative assets that have zero volatility or have a quarterly NAV or a quarterly reevaluation of the NAV, that's a good asset to have, provided it's safe, provided it's high quality, provided it's well managed. Those make sense as an alternative to a combination of equity and fixed income. I'm live here with Martin Roberge. I'm Rob Tatro, Portfolio Manager, Canaccord Genuity Wealth Management, and the Tatro Wealth Advisor Group. If you'd like to book a no-obligation consultation with Rob, that's me. Go to www.speaktorob.com. We'd love to book something for you. Martin Roberge, live here from La Rive Sud. Let's take you to the next slide here, Martin. I believe the next one is on commodities. Do you want to chat briefly on this one?
Yeah, this is the relationship between, when you talked earlier, Rob, about liquidity, like the surge in liquidity. Well, you can measure liquidity using various metrics. One that I like is to look at the increase in monetary aggregates. This is like basically the money sitting in bank accounts, cash deposits, or in mutual fund money market assets. Okay, so if you sum all this cash ready to be spent, okay, together, and then you look at the relationship with the economy, the blue dotted line shows if there's too much cash versus the economy or too little cash. So the higher the blue dotted line, the higher the amount of cash relative to economic growth. And what we've seen this year, as you mentioned earlier, like, it's an exponential spike in liquidity and in monetary aggregates in the US. And historically, when you look at this gap between liquidity and growth has been very weak. So the spread is really high. And that means that economic growth is likely to improve because we've got liquidity to fuel it. But most importantly, for commodity investors, it means more commodity demand. More commodity demand means higher commodity prices. So the reason why I want to put that chart there is because commodities is an asset class, Rob. Okay, we tend to forget about it, but it's an asset class. You can buy ETFs that are replicating the performance of a commodity. Okay, you got to be careful on which ETF to buy, but certainly this is good from a commodity price of view that Canada should normally participate to this non-US rally owing to this surge to come in commodity prices. And the bar is very clear. The commodity, the super bull in commodities is likely to be a 2021 story, but the stocks will anticipate this 2021 a year in advance. Hence, some of the resurrection we've seen in base metal stocks, copper, for example, wouldn't rule out to see oil eventually participating energy equities as well. But this is just a reminder that if we've got a good commodity price environment in 2021, this is obviously a good thing for Canada because we are very resource centric. So when it comes to comparing Canada versus US, there's a tactical, and this is just a tactical cycle where Canada could at least match the performance of the US market.
So you mentioned a lot of things there. I think one of the key is, first of all, Canada is a commodity-based economy. If you didn't know that, welcome to the show. And there you go, free piece of news for you. A lot of commodities in Canada, lumber and the base metals and, oil, and aside from the ones that we know, even water and whatever it may be. But
gold as well.
Gold, yeah, for sure. Do you see, I look at some of these micro cap stocks and these micro cap sectors, the mining, some of the exploratory stuff. Do you think that those things could come back, Martin? I know, that's not supposed to be the topic of the day, but we've seen them down for so long.
Yeah, actually, if you look at in the US, they have the FANGs. Okay, there is some kind of a bubble brewing in that segment of the market. And in Canada, we're not there yet, but we've got the TSX Venture. The TSX Venture is up year to date. Can you believe it? Okay. So it's a basket of small cap mining stocks, mostly gold. I would say probably half of the weight is gold and half is I would say industrial metals and lumbers and other commodities. And I think it reflects the fact that these stocks have been like out of the radar screen of so many people for so long that now that you've got the gold price moving and now also copper moving, it seems like finally there could be some catch up to the larger cap companies, because if you look at most stocks trading in the small cap index or the venture index, like they trade at very, very depressed multiples. And it seems like we're seeing just like at least a realignment with the valuations of larger cap equities.
They've been, as my dad would say, in the penalty box for way too long. Nobody wants to give them any respect. They're going to stay there until they have to show. They typically will have to show earnings or show something. But it's really interesting. The TSX Venture, a lot of money's been made in the venture in the old days, and a lot of money's been lost in the last, I don't know how many years on the TSXV. And it's up 2020. Who would have thought? I believe you called that when we met in October, November. We had a meeting here in my office, and I vaguely recall you calling that exact scenario. I'll move on here on the topic of interest rates. I just want to remind you guys that was a 30-year chart that we showed. 30-year chart. When I got into the business, interest rates were at 5 or 6%. These bond yields. And everyone was saying, hedge your portfolios against rising interest rates. They're going to go up. They're going to go up. Interest rates are going up. And then a year or two passed, another year passed. Now we're at 3 or 4%. You got to protect your portfolios, rising interest rates. They're going up. They're going to go up. And another year or two. And now here we are, zero rates. And we got to protect our portfolio against rising interest rates. It's been straight down here for a long time. I will take you to, I believe, slide 15 here is what you wanted to show me here, Matthew?
Yeah.
So this is the comparison of growth valuation and the U.S. considerations.
Yeah, it's the if you remember earlier in the show, we talked about the 3 conditions for international equities outperformance. First, they are a high beta economies to the world economy. So
And
you need global growth reacceleration.
I'll pause on just the beta just to make sure viewers understand. Beta is the relative movement relative to the index. So the movement relative to the index. So if the index moves 1 point, if you have a high beta, you're moving more than that. If you have a low beta, you're moving less than that. Go ahead, Martin.
Yeah, it's a measure of sensitivity. Okay, call it. I like to use sensitivity. So it's again, global equities are very sensitive to the global economic cycle. And since we are reaccelerating from almost ground zero, okay, that's one positive. The second variable we talked about was the US dollar. We need US dollar depreciation, and it seems like finally we're going to get it. This last one, which is a chart, page 15, is the valuation launchpad. You need to have, you need to see, you need a margin of safety to buy international equities versus US equities because they are more cyclical. And how big is the margin of safety right now? Well, it's at a new all-time high. Okay.
So this margin of safety, Martin, is the spread.
Is the spread the third panel at 6.5, I believe?
Yeah, the spread between ex-US and US.
That's right. So
6.5 times.
Yeah. This is almost.
This is the PE ratio, correct?
Yeah, the PE ratios are in the second panel. You can see.
Yeah.
US is around. I cannot see the number, but it's around 22 something.
22.1, and the world ex-US is 15.6. So 15.6 is there's value there.
Yeah, and don't forget those markets pay a good dividend yield as well.
Right,
so
which is not reflected.
And low PE. So historically, again, the margin of safety used to be lower than that, but because we've seen, the trade war, China, US, and globally a lot of policy uncertainty with the Brexit, people decided to stay in North America or more in the US. But now that we've got the UK Brexit out of the way, we've got China really stepping forward when it comes to stimulating their economies. You can see the Chinese stock market on fire lately, and this is all the good stuff that you need to see for non-US equities to outperform. Because don't forget, in Europe, those countries like Germany, Italy, and Italy less so, but Germany is certainly very sensitive to the Chinese economy. And all those countries are satellite countries to China. And China, I'm telling you, the central bank is not sleeping at the wheel. They are really, really adding like a lot of liquidity in the financial system because, as you know, next year is the 100th year anniversary of the Conservative Party over there. So they want to make sure that the economy looks good. So they are really tackling the economy by cutting rates, issuing bonds, cutting policy rates. And you want to have exposure to the China economic cycle with international equities. And those are obviously cheaper than in the US. So my hunch, Rob, is that following 11 years of underperformance, I think we have a shot at outperforming the US for maybe a year or two here.
The trade basically is back here in 1989 and 1994, the spread was 10 the other way. You had a 10 spread on the PE. So international equities were trading at a 10 times higher multiple than US equities. Yeah. And back then, the trade would have been to buy the US equities. And now you're saying the reverse is happening. It's the highest it's ever been, this spread, 6.5. So the trade is to buy global equities. Now, I will say this, if you're a watcher of our show or if you're a client, we have global equities in all our portfolios. We've been kind of overweight relative to Canada. We've been overweight US and global. So if you're a client of ours, you have some of this, you're okay. We're well aware of this. But if you're not a client of our group, I will say this. I see portfolios all the time from different institutions. I'm not going to name names of different firms, but I will say that we pretty much always see portfolios that are super, super overweight Canada, a little bit of US sometimes, and rarely do they even have the global in there. So if you're watching this and you know you're not here, there's a good chance you don't have a ton of global exposure, and you might miss out on this trade. So go to www.speaktorob.com. We'd love to chat with you about that. Martin, anything else that I should cover here on these slides?
No, I think we've covered pretty much what I wanted to say to your viewers, and again, just to conclude on equity allocation, we ran a little analysis a few years ago, and we calculated that the optimal mix of global including US, like for a domestic based investor investing internationally, you needed to have 70% of your equity holdings outside Canada, because outside Canada historically is where you get the higher returns. And when things go bad, these currencies do better than the Canadian dollar. So this is where you get your diversification benefits. It's not only because you can capture higher expected returns, but also the currency exposure that you have in these markets provides you with a cushion, because the Canadian dollar normally goes down every time we have a risk off or a difficult environment for stocks. So just keep that in mind. 70 to 30. Look at your equity holdings. Are you at 70% outside Canada? No? Well, you know what you need to do.
You need to give us a call. It's funny that you mentioned that. It's almost like I read that study maybe 2 years ago. We've been kind of around that number for a long time now. I want to say we've been plus or minus 5-ish% of that 70% number now for a while. Remember, Canada is, what is it, 1.6% of the global GDP, Martin, something like that. And yet we consistently see portfolios of Canadians have 70, 80, 90% of their equities in Canada. So it's just smart diversification. You heard it here from Martin Roberge. Martin, merci beaucoup. Thank you for taking the time. Any last words here before we get you on the show in a couple months, in our next quarter maybe?
Well, let's start next quarter, and everyone on your show have a nice summer. Like, I don't know about Winnipeg, but here it's been so nice. I don't know what's the cause of that, but it's been so nice. It's 30 degrees, no clouds, like it's blue sky. And like, let's enjoy, like, as you know, guys, in Winnipeg, the winter comes around like way too fast.
We know, Martin. We know. So, we're well aware how terrible the winters are in Winnipeg.
Let's enjoy the rest of the summer. And
you know what came out this week, over the weekend in Winnipeg? No. Les maringouins, les moustiques, the mosquitoes are out. So mosquitoes are out in Winnipeg. So it's a little early, and they were a little aggressive over the weekend, but they're out now. So that's a fun thing you got to deal with every night when the sun goes down for 2 hours. You can't be outside because the mosquitoes are going to eat you alive. So that's super fun. No, I'm kidding. Winnipeg's the best place to live, and the summers are fantastic. Mosquitoes you deal with, you just put some spray on. And at least we had 0 COVID cases over the weekend. Yeah, that's good. So, we got that under control for now. All right. So, merci beaucoup, Martin. Thank you so much, guys. It was a pleasure to have you again on the show. Next Monday, I believe we have our financial analyst joining us. We're going to talk about some bank stocks. Looking forward to that episode. We're going to zone in specifically on the financial sectors, the different stocks that he's covering in there. I believe it's Scott Chan, if I'm not mistaken. Scott Chan, yeah. So excited to have him on the show. If you do, please, if you're watching on YouTube, take a sec to subscribe. If you're watching on Facebook, follow, share, like. We'd love to hear your comments. And I will wish you all a great rest of the week. Merci. Thank you, guys.
Bye-bye.